Good morning and welcome to the post-MPC press conference. The Monetary Policy Committee of the Central Bank of Kenya met yesterday, the 5th of December 2024, and today, the 6th of December, the Governor, who's also the chairman of the MPC, will take us through the thinking of the MPC, and he'll also be able to take in your questions. As a reminder, please send your questions in through Slido. That's www.slido.com. Please make sure you introduce yourself by name and institution. There's a provision for that within Slido so that we're able to then track the questions properly. For now, I'd like to introduce and welcome the Governor of the Central Bank of Kenya, who is also the chair of the Monetary Policy Committee, Dr. Kamau Thuge.
Thank you very much, and good morning, everyone. The Monetary Policy Committee met yesterday and lowered the central bank rate, the CBR, from 12% to 11.25%. In doing so, the Monetary Policy Committee noted that the overall inflation was expected to remain below the midpoint of the 5 plus or minus 2.5% target range in the near term, supported by low fuel inflation, a stable food inflation, as well as the exchange rate stability. The non-food, non-fuel inflation has moderated and is expected to remain stable. Central banks in the major economies have lowered their interest rates further, with expectations of a gradual pace of reductions in the coming months. Economic growth in the first half of 2024 had decelerated together with credit to the private sector, and therefore there was scope for a further easing of the monetary policy stance to support economic activity while ensuring exchange rate stability. The Monetary Policy Committee observed that short-term rates on government securities had declined sharply in line with the CBR, but that banks had not responded by lowering their rates proportionately. The MPC therefore urges banks to take necessary steps to lower their lending rates in order to stimulate credit to the private sector and thereby stimulate more economic activity. The Monetary Policy Committee will closely monitor the impact of the policy measures as well as developments in the global and domestic economy, and stands ready to take further action as necessary in line with its mandate. The committee will meet again in February of 2025. Starting with a summary of global developments and outlook, the global headline inflation has declined, supported by lower commodity prices. Central banks in major economies have continued to lower interest rates, including the US Fed, the ECB, and also the Bank of England. They are expected to continue lowering interest rates, but at a gradual pace. Global growth continues to recover and is expected to remain at 3.2% in both 2024 and 2025, supported by strong growth in the US and India, as well as improved growth prospects in the UK. Risks to global growth outlook relate to elevated geopolitical risks, particularly the conflict in the Middle East, as well as the Russia-Ukraine war. Global financial conditions are expected to be relatively volatile in the near term, mainly reflecting heightened geopolitical tensions. Kenya's real GDP growth is expected to remain above the global, the sub-Saharan Africa, and emerging market and developing economies averages in both 2024 and 2025. Starting with the global inflation, inflation has declined, mainly driven by lower commodity prices. The headline inflation for the US, for example, is now at 2.6%. The UK inflation is at 2.3%, and the Eurozone is also at 2.3%, very close to their target range of 2%. Core inflation continues to be sticky, mainly driven by services price inflation. Overall, we expect overall global headline inflation to decline from 6.7% in 2023 to 5.8% this year, and to further decelerate to 4.3% next year. In terms of international oil prices, these have moderated throughout the year, and expectation is that going forward, both supply and demand will be matched, and that prices will remain relatively stable. Food inflation has increased in October, driven by higher edible oil prices, and edible oil prices didn't increase in October, driven by higher prices of palm, soy, and sunflower as a result of reduced production in Southeast Asia, but also because there is an increase global demand for biofuels. Turning to global economic growth outlook, growth is expected to remain at 3.2% in both 2024 and 2025. Again, as I said earlier, supported by strong growth in the US and India, and also the improved prospects for growth in the UK. The United States growth is expected to slow down somewhat from 2.8% this year to 2.2%. The United Kingdom should accelerate from 1.1% to about 1.5%. And the euro area is expected to increase overall production from 0.8% in 2024 to 1.2% in 2025. In the case of Saudi Arabia, the projected growth is to increase from 1.5% this year to 4.6%. These are key trading partners of Kenya, and we do expect with that resilient growth that should result in Kenya benefiting either from higher remittances or higher exports, particularly of horticulture to the EU, and also increased tourism from all those areas, the United States, as well as the United Kingdom and the Euro area. Again, just looking at the interest rate differential between Kenya and the United States, you can see that the interest rate differential, which is the line in between, the red line is the 91-day Treasury bill in the United States, and the blue line, the very top line, is the 91-day Treasury bill in Kenya. And if you go back to 2023, you can really see that the differential was relatively low, around 5 percentage points. And now, even as we lowered the CBR yesterday, the interest differential is well above 8%, very close to 9%. So, in other words, we don't expect that this reduction in interest rates will result in capital outflows, because investing in the Kenyan securities is still more profitable than investing in the U.S. Treasury bills. In terms of the global financial market conditions, these were relatively volatile in November of 2024, reflected in a decline in the performance of equity markets. And this volatility is really as a result of heightened geopolitical tensions, particularly in the Middle East, although the reduction in interest rates have provided some liquidity to the markets. And we have seen the yields, for example, on the Eurobonds declining, and therefore increasing access for emerging markets to international capital markets. Turning to the domestic economy, the overall inflation, as I said earlier, has remained below the midpoint of the 5 plus minus 2.5% in both October and November, but it has actually been below the midpoint since around July. In November, the rate was 2.8%, largely unchanged from the 2.7% that was recorded in October. Food inflation rose marginally, reflecting a modest rise in non-vegetables price inflation, which was attributed to higher prices of a few items, particularly cooking oil. Fuel inflation remained low, mainly on account of lower electricity as well as pump prices. Non-food, non-fuel inflation moderated on account of muted demand pressures. And finally, the stability in the exchange rate has minimized imported inflation. The inflation rate is expected to remain below the midpoint of the target range in the near term, and this will be supported by food inflation continuing to remain low and stable on account of the improved supply because of the good weather. It will also be supported by continued stability in the exchange rate. It will also be supported by fuel inflation, which is expected to remain low due to base effects, the stable exchange rate, and the easing of international oil prices. The non-food, non-fuel inflation is expected to remain low and stable. The main risks to inflation relate to uncertainty on the evolution of international oil prices due to the escalation of geopolitical conflicts, the Middle East, and Russia and Ukraine. So as I indicated, overall inflation remained broadly unchanged in October and November. And you can see there has been a persistent decline in overall inflation from as high as 9.6 in October of 2022 to the current rate of 2.8% in November. The slight increase from October to November from 2.7 to 2.8 can be explained by the small increase in food inflation from 4.3% to 4.5%. Otherwise, the fuel inflation was recorded negative inflation at minus 1.6 compared to minus 1.7. And the core inflation, or the non-food, non-fuel, showed stability with a small decline from 3.3% in October 2024 to November 3.2% in November of 2024. In terms of contributions to overall inflation in November, food continues to contribute the significant portion of the domestic inflation, accounting for 1.7 percentage points, and this is followed by the non-food, non-fuel with a contribution of 0.8%, and then finally fuel inflation contribution is about 0.2 percentage points. In terms of the main drivers of food inflation, the food inflation, as I indicated, did increase slightly in November of 2024, and this was as a result of a modest increase in non-vegetable price inflation, which, however, remains low. In terms of the contribution to food inflation, looking at the November inflation of 4.5%, the non-food, non-vegetable inflation, which is in green, contributed only to 1.1 percentage points of the 4.5, and the rest was contributed to by the vegetables inflation. The right-hand panel shows the 12-year inflation for vegetables as well as for non-vegetables. And starting with non-vegetables, you can see that around July, non-vegetable inflation was negative 0.8, then it reduced to negative 0.2, and then by November, the contribution was actually positive at 1.3%. On the other hand, the vegetable inflation has been decelerating since July, when it reached a maximum of 33.3%, and has continuously declined to 28, to 22, 18, and now in November it was only 15.2%. Looking forward in terms of inflation expectations for the next 3 months, the survey, the agricultural survey that was taken in November, shows that inflation is expected to remain within the target range in the near term. And indeed, a majority of the respondents, 52% of respondents, do expect inflation to decline or remain unchanged in the next 3 months, and only 48% expect inflation to increase. Our own projections indicate that by the end of March of 2025, inflation will still be around 3.3, well below the 5% midpoint of our target range. In terms of the domestic economic growth, this growth averaged about 4.8% in the first half of 2024, and this was down from 5.5% in the first half of 2023. The slowdown reflects deceleration in growth in most sectors of the economy. Construction and mining and the quarrying sectors recorded actual contractions. For 2024, the growth is projected at 5.1%, and it is expected to accelerate to 5.5% in 2025. And this reflects, for 2024, it reflects the slowdown in growth in the first half of 2024. It also, for 2024, reflects the deceleration in private sector credit growth to key sectors of the economy, particularly manufacturing, construction, and transport and storage. For 2025, the acceleration of growth in 2025 to 5.5 reflects the resilience of key service sectors such as agriculture and improved exports, which are expected to continue to support growth in 2025. In addition, growth will also be supported by implementation of trade initiatives, including the Kenya-EU Economic Partnership Agreement and export promotion measures. The main risk to the growth outlook relates to continued geopolitical tensions, again in the Middle East and Ukraine, which have the potential to disrupt supply chains. In terms of sectoral contribution to growth, we are projecting agriculture to continue to be a main engine of growth. For this year, we expect the agriculture to end the year with a growth of about 5.3% and to have a similar growth of 5.6% in 2025. In regard to the industry sector, we do expect a stronger recovery compared to this year. This year, we expect only 1.1% growth because construction has really been not doing very well, and similarly, mining also has not done very well. But for 2025, we do expect some recovery in construction. We do expect lower interest rates from the banks, and that should encourage more construction. and we also expect more construction from the government. Also manufacturing, although we do expect stronger growth in manufacturing than this year of 3.1 compared to 2.7. This is still well below the potential, but we do expect now the government policies, particularly in terms of encouraging value addition, to pick up pace, and therefore the industry sector we expect now to perform somewhat better than in 2025 than in 2024. The services sector are also expected to recover from 6.2% this year to 6.9%. 6.9% is roughly the growth of the services sector that was that was achieved in 2022 and also in 2023. So it's not overly ambitious. It's just in line with previous levels of growth. So at the bottom line there is the real GDP growth. As I said, we expect an acceleration in the 2025 for the reasons I've just outlined. The leading economic indicators suggest that the third quarter for this year that is about to end of a growth of 5.2. So as I said earlier, we are projecting growth of 5.1 in 2024 this year. And this in part is supported by this, the performance of the leading indicators, which indicate that for the third quarter, real GDP will grow by 5.2%. And that 5.2% is supported by the fairly strong, continued strong performance of the agricultural sector. You can see there that maize, wheat, beans, Irish potatoes, sorghum and millet all continue to show fairly strong growth. In terms of sugarcane deliveries through the third quarter, September was fairly strong. Milk deliveries also had recovered, was a bit mixed, but did recover somewhat in September. In the manufacturing sector, again through the third quarter, total power consumption has been fairly strong. The large power consumption also strong, and we're looking at the red line is the performance in 2024, and the green columns are actually the growth rates comparing the previous year and 2024. And similarly, you can see sugar production is fairly strong. In, for example, in September, it grew by 340%. And soft drinks production also performed well in August, not so well in September. With regard to the services sector, just a few sectors, select sectors. The volume of bank to e-wallet transactions remains positive. The throughput at Port of Mombasa remained positive, as did the volume of mobile money deposit transactions and the tourist arrivals. On the negative side is the sectoral growth in credit to the private sector, where we saw in manufacturing, this has decelerated quite significantly from a positive 23% at the beginning of the year to negative 11.6 in October 2024. Transport and communication growth has recovered slightly from the negative growth in August to 8% in October, but the trend is still a deceleration of credit to the private sector in the transport and communication sector. In the building and construction, this has been performing relatively not so positive in the sense of negative growth in credit to the private sector. has been negative and has been actually accelerating in a negative direction, with the 12-month credit to the private sector in the building and construction sector reducing by 16.7%. Consumer durables, again, the trend is negative in terms of credit to the private sector, although it remains positive, but a low positive. Moving to monetary developments, the growth in money supply moderated further in October of 2024, mainly reflecting a deceleration in credit to private sector growth, and also because of the exchange rate valuation effects, where the shilling has appreciated quite significantly. The growth of credit to the private sector across most sectors has slowed down, reflecting the impact of the exchange rate appreciation on forex-denominated loans, but also because of higher lending rates due to lagged effects of previous tightening of monetary policy and higher government domestic borrowing. The short-term interest rates have declined in line with the reduction in the CBR, and commercial banks' average lending interest rates have yet to respond substantially, but they are expected to decline in line with the short-term interest rates. Returning back to broad money supply, there has been a moderation in growth, and again, this has reflected the exchange rate valuation effects attributed to the appreciation of the shilling. And there you can see when you include the valuation effects, you see the orange line where the M3 by October is only growing by 0.8%. However, if you take into account the valuation adjustments from the exchange rate, then broad money supply would have grown by 5%. However, it is important to note that there has been a shift of deposits by the private sector from depositing with the commercial banks to buying. We have made it much easier to buy government securities, and so there is a substitution by the private sector between deposits and holding government securities. Going to the credit to the private sector, the orange line shows the credit to the private sector decelerating from about 13.8% at the end of 2023 to 0% in October of 2024. However, as I said, this does reflect the impact of the appreciation of the exchange rate, but once we make that adjustment, the deceleration in credit to the private sector is not as dramatic as when you include the exchange rate. Nonetheless, there is a slowdown in credit to the private sector from a peak of about 9.1% around for this year around March to 3.8% in October. In contrast to the deceleration of credit to the private sector, growth in credit from SACCOs has been relatively resilient, and this has reflected the relatively lower interest rate charged by SACCOs compared to the commercial banks. And as a result of that, the credit from the SACCOs has been, for the last 3 months, has been accelerating from 9.3% to 11%, and then by October had reached almost 14%. Of course, the share of credit to the private sector provided by SACCOs is relatively low. But if you look at this table at the very bottom, and you look at the end of December 2023, you see the share of credit to the private sector by SACCOs was about 14.2%. From the microfinance banks was 0.9%, and from the banks was 84.8%. If you now go all the way to 1 year later, roughly 1 year later to October 2024, you'll see that the share of credit to the private sector from SACCOs has actually increased by about 1.7 percentage points, and the share for the banks has declined from the 84.8 to 83.2, has declined by the roughly the same amount of 1.6 percentage points. Looking at comparing the interest rates, the CBR rate, the 91-day Treasury bill, also the lending rates, the red line is the average lending rates of the banks. And you see it has increased to a level of 17.2% around October. And indeed, it was increasing from around, let's say, July, from around July of last year, when the CBR started to go up and when the Treasury bill rates started to go up, the lending rates did go up. However, when the CBR has now been going down and there has been a significant reduction in the 91-day Treasury bill, almost from 16% to now, with the auction, yesterday's auction, the 91-day Treasury bill rate is at 10.45. The lending rates for the commercial banks have yet to move. So we do expect that going forward for this, the lending rates for commercial banks to come down to reflect the fact that other interest rates, the CBR rates, and also the Treasury bill rates have gone down, and this should reduce their cost of funding, and that should be, that saving should be extended to the borrowers in the form of lower commercial banks lending rates. Again here, just to show the impact of lower inflation and higher commercial bank lending rates, to really look at the real interest rate. And here again, just going to the end to October, where the lending rates were 17.2%, but inflation was 2.7%. And the difference there of around the 14% there is the real interest rates. And the real interest rate in October was at one of their highest levels. And you can see there's been a persistent increase in real interest rates since around July, but more dramatically since July of 2023. And these real interest rates are relatively high, and we do expect now the commercial banks to respond to the generally lower interest rates, not only here but also globally, and to lower their commercial lending rates in order to encourage more borrowing from the private sector. Our new monetary policy framework, which now aligns better the interbank rate to the CBR. If you look at the fluctuation of the purple, kind of the purple line, which is the interbank weighted average rate, you can see it has been kind of fluctuating around the CBR, but now we have been able to virtually make the overnight rate, the interbank rate, very close to the CBR rate. And this has improved the monetary policy transmission, so that any time now we either increase the CBR or lower the CBR, we are able to take monetary policy actions to ensure that the interbank rate is very close to the CBR rate. Moving to the balance of payments, the current account deficit was 3.8% of GDP in the 12 months to October of 2024, from 3.7% of GDP in the 12 months to October 2023. And this reflected improvements in goods exports and resilient remittances and import recovery due to a stable exchange rate. The current account deficit is expected to remain stable at 4% of GDP in 2024 and 2025 and over the medium term. And this reflects the improved exports, especially of agricultural commodities, resilient remittances, trade and investment initiatives, and of course, continued good performance of tourism, and also the recovery in imports, which will be supported by a stable exchange rate going forward. The projected current account deficit in 2024 is expected to be more than fully financed by capital and financial inflows, which will result in an overall balance of payment surplus of US dollars 937 million. And this surplus, when we combine it with the disbursements from the IMF, will allow us to build our the international reserves of the central bank by roughly $2.2 billion. These are details of the balance of payments, but it just covers what I just mentioned, which is the current account is of the second column from the right, shows the current account of about $4.9 billion. But that is more than covered by the financial account. You can see down the line, down the page. And the very last lines show the buildup of international reserves by the central bank of the $2.2 billion that I just referred to. The current account has been narrowing. It was about 5.1% in 21-22. In 2023, it came down to 4%, and we do expect going forward that the current account will remain at this sustainable level of 4% of GDP. In terms of exports, goods exports increased by 15% in the first 10 months of 2024 compared to the same period in 2023, and this was driven by exports of agricultural commodities and re-exports. It's important here to just contrast this significant growth in exports for the first 10 months of 15% versus the contraction of exports last year, where we only exported $7.2 billion compared to the previous year, where we exported $7.4 billion. So this year we are doing much better than we did last year, and therefore expect that the overall exports performance will be 11.6% higher than in 2023. In regard to the goods imports of goods, this has, for the first 10 months, it has increased by 9.6%. And this is, again, in contrast to what happened last year, where for the whole year of 2023, imports actually declined by almost 11%. So this year, we are projecting an increase in imports by 10.7% for the year as a whole. With regard to remittances, Last year, remittances only grew by 4%. For the first 10 months of this year, we've seen very strong performance of remittances, which have increased by 17.7%. And therefore, for the year as a whole, we are projecting remittances to increase by 17.5% and to reach almost $5 billion by the end of this year. This year is exceptionally strong, and so we do expect a growth of 7% in 2025, given the high base and given the very strong performance in 2024. In regard to tourist arrivals, the first 10 months of this year continues to show a lot of resilience and strength, with arrivals increasing by 18.2%. So and this is compared to very strong performance in the last 2 years, where in 2023 the increase was 31.4%. So this 18.2% is very strong, and it is on a fairly strong performance in the previous years. So that strong performance in the overall balance of payments, as I said, will allow us to build our international reserves, and by December 4th, 2024, already our gross usable reserves had reached $8.9 billion. And as you can see there, this is the highest level of reserves we had reached. Earlier on towards the end of November, the level had in fact reached about $9.3 billion. So the external sector is doing relatively well, and we now do have sufficient foreign exchange reserves to deal with any kind of external shocks. Again, reflecting the strength in the external sector and the balance of payments, the shilling exchange rate has appreciated by 17.4 since the beginning of the year. And here we have we are contrasting it with the developments in other global currencies, including the US dollar, which has itself appreciated by 4.8% this year. And of course, the South African rand, only 0.53, all the way to the depreciation of the Mexican peso of about 22.3%. Closer to home, comparing the shilling performance with other currencies in Africa, again, ours has appreciated by 17.4, and at the other end of the spectrum is the Ethiopian birr, which has depreciated by 121%, reflecting the reforms that they are implementing in the foreign exchange market. The Nigerian naira has also weakened by 90%, as has the Egyptian pound and the Ghanaian cedi. So the Kenyan shilling has remained relatively stable, and this is really also an indication of the confidence in the economy, particularly of foreign investors. And you can see the path since around March of this year, when the exchange rate reached 131 from a level of above 160. The exchange rate has remained relatively stable, and for the months from around August to now, the rate has remained at around 129. Indeed, the figure we are showing there of 129.6, in the last few days we've seen also a strengthening of the exchange rate, and the current exchange rate is is really about 129.3. With regard to fiscal performance, the government continues to be committed to fiscal consolidation and to reducing the fiscal deficit over the medium term in order to reduce the debt vulnerabilities. And you can see the line there of the reduction in the fiscal deficit starting all the way from 2020 to 2021 when the deficit was 8.3%. It has declined to 6.2, 5.6, and in the last financial year it was 5.2%. The supplementary budget that was submitted by Treasury to Parliament earlier mid this year shows a further reduction of the deficit to 4.3%, and this will be followed by further consolidation to below 3% of the fiscal deficit by 2028-2029. Finally, on the banking sector developments, the banking sector remains stable and resilient. The total capital adequacy ratio stood at 19.1% in October 2024, which was the same as in August of 2024. And similarly, the liquidity ratio was 54.3% in October, which was the same level as in August of 2024. This compares with the minimum statutory requirements of 14.5% for the capital adequacy ratio. In other words, the actual ratio is at 19.1 versus the statutory limit of 14.5%. And in the case of the liquidity ratio, the current actual liquidity ratio is 54.3%, and this is compared to the statutory limit of only 20%. The gross non-performing loans to gross loans ratio decreased marginally to 16.5% in October of 2024 from a level of 16.7% in August. Banks have continued to make adequate provisions for the NPLs, and the sector remains profitable, providing sufficient buffers. The cumulative banking sector pre-tax profits increased by 25.7 billion, or about 13%, to 225.3 billion in October of 2024, compared to 199.6 billion in October of 2023. Thank you very much. That's the end of my presentation.
Thank you very much. That was the Governor of the Central Bank of Kenya, plus also doubling up as a chairman of the Monetary Policy Committee. So jumping straight into the questions, there's quite a number. We begin with the banking sector. So we start with Harold Allo from the Africa Report, who says that some banks are slow in cutting rates in line with the central bank rate, citing lags in risk-based pricing, and he's asking the governor for his view. All the following ones are related, actually. Kefa Moirori from The Nation, saying that banks have cited rigidities, including high money market rates, non-performing loans as hurdles to lower loan costs. Now, with the former handled by the central bank rate cuts, how can the latter be resolved? Patrick Alushula from the Business Daily, banks' weighted average lending rates that the CBK publishes monthly shows figures that are way below market. Are these rates before margin and customer risk? Finally, Eric Mokaya from Mwango Capital says, how confident is the CBK that banks will align their lending rates with the lower CBR, and what mechanisms are in place to ensure timely transmission of this? He also asks, could the CBK's request for banks to lower lending rates proportionate to a rate cut be seen as politically influenced, raising concerns about its independence?
Let me start with the first. First question is whether some banks are slow in cutting rates in line with CBR, citing lags in risk-based pricing. So suddenly the banks have been sluggish in lowering their lending rates, and as you know, I've had meetings with the banks. The last 2 weeks ago, we had a meeting with all the CEO of banks, and I do believe that they understand the need now to start lowering aggressively interest rates that they charge to consumers. Of course, one of the issues that we did discuss was the fact that there had been, because now the Treasury bill rates are the rates had been attractive to depositors. There had been some movement of deposits from the banks to Treasury bills, and that had raised, for them to attract the deposits, they had to raise the interest rate they give on deposits, and that raised the cost of funding, which they passed on to consumers in terms of the higher lending rates. But what we are telling the banks is that now the situation has reversed. The 91-day Treasury bill, which was around 16% only a few months ago, is now at 10.45%, and therefore, even now as this starts to some deposits starts to mature, that they should now be able to reduce the cost of funding, and they should translate that cost of funding. Those savings should now go to reducing their lending rates, so that we can start really giving more credit to the private sector, maybe less to government, and so we can really stimulate economic activity and start generating some jobs. So I think, Kefa, I think I've answered your question, but if I haven't, you can ask it in a different way. Patrick Alushula says banks' weighted average lending rates. The CBK publishes monthly shows figures that are way below market. So I think, Patrick, I think what we do is obviously this is it's an average of the rates. Averages means there are some that are higher and some that are lower. I think that is the only, we get that information from all the banks, and then we do average them out. So it's indeed a case that what we publish, some rates will be much higher, and of course some rates will be lower than what we publish. Mr. Mukaya asked how confident the CBK is that banks will align their lending rates with the lower CBR. So, Eric, I think it's in the interest of the banks to lower their lending rates. I think if they continue on this path, it's a no-win for anyone. It's a no-win for the banks, and the economy will not be able to perform. On the other hand, if they do lower these rates and stimulate economic activity, this is a win-win for everybody. The banks will make more profits, and the economy will benefit from more credit. The economy will become more active. So I think there is a vested interest, even for the banks, for them to lower rates as aggressively as they can. I think our request, the CBK's request for banks to lower lending rates, I don't think that is political. It's just indicating that, look, when central bank raised the policy rate, the banks were very quick to raise their lending rates. All we are asking is for the banks to be fair and to act in the same way that they were quick to raise lending rates when the policy rate was increasing and the treasury bill rates were increasing. They should equally reduce their lending rates as soon as possible. I think that does not affect really how we can be seen as not being independent.
The second batch of questions will begin with George Obulutsa from Reuters. So George is asking for an update on progress made towards Kenya requesting a new IMF program once the current IMF program runs out in April. David Herbling from Bloomberg News, to what extent has central bank intervention influenced the exchange rate, and which macroeconomic factors will influence the exchange rate in the short term? From Patrick Alushula again, the Auditor General's position is that the Central Bank of Kenya flouted procurement processes in the 14.5 billion shilling currency printing tender, and he's asking for CBK's take on that.
Let me start with the IMF program. We are in discussions with the IMF to see how and what will our engagement will be in the future. The current arrangement that we have with them expires in April of this year, as you have indicated. The Deputy Managing Director will be visiting next week, and we'll have further discussions to see how we'll take our engagement with the IMF forward. I think on the intervention, the question is by Herbling whether the extent the central bank intervention has on the exchange rate and which macroeconomic factors. Look, as I've said frequently, our real intervention is just to prevent excessive volatility of the exchange rate. What will ultimately influence the direction of the exchange rate will obviously be the performance in the balance of payments. If more foreign exchange comes in, then the exchange rate will tend to appreciate. If less and more goes out, then the exchange rate will tend to depreciate. On the Auditor General's report, I would say that we have engaged with the Auditor General, and we did explain that this procurement process was approved by the Cabinet, was approved by the National Security Council, and there was that approval to allow us to undertake this procurement process. So that, in our view, was approved by Cabinet.
The third batch of questions, starting with Kevin Rotich. Kevin is from Capital FM, who's asking whether the higher capital requirements for banks, will it drive mergers, acquisitions, and consolidation, which is a similar question from Kefa Moirore, again from the Nation Media Group, about the transition to 10 billion shillings for banks' core capital, which is now set. How fast does the CBK expect mergers and acquisitions to follow in the industry as lenders race to meet the requirement? Martin Muita from The Star, who's asking, with inflation within target range going into 2025, should there be expected a further rate cut on the central bank rates? And also, what's the expectation on bond yields?
Yes, I think Mr. Rotich, the higher capital requirement for the banks was indeed expected to strengthen. First, was expected to just strengthen the capital buffers of banks and improve their resilience and ultimately strengthen the stability of the financial sector. We do hope that there will be mergers and in our view, having stronger banks and having stronger capital base will be able to withstand many of the new risks that we are seeing, whether it's from cyber security and of course even more recently some of these really fake news. And I think this is really the right way to go. It is also the right way to go in terms of having financial presence in the region, and maybe not just in the East African region, but also in the wider sub-Saharan Africa. But you can only do that if you have strong banks and banks with a strong capital base. So on the issue of the inflation being within the target range going into 2025, again, our decisions as a Monetary Policy Committee are data-based. As I said, we are going to meet again in February. At that point, we will see what inflation has been in both December as well as January. We'll also be able at that time to look at what has happened to the exchange rate, whether the exchange rate is still stable. And we'll also be able to see by that time the reaction of credit to the private sector. And our decision on the CBR at that point will be based on the outcome of those particular indicators.
Thank you. The final batch of questions, we shall begin with Adrian Terry from Torrance Labs, who's asking a similar question to Kevin Rotich again from Capital FM about Safaricom. So the way Adrian puts it is, what's the status of Safaricom M-Pesa separation at the end of the calendar year of 2024? And for Kevin, saying what's the latest update on separating M-Pesa from Safaricom, where he says the governor had mentioned a tax dispute that was delaying the process. Finally, Eric Mokaya, does MP's exemption of Safaricom's Lipa Mdogo Mdogo from the CBK control weakens CBK's ability to perform proper credit sector oversight?
I think on the Safaricom, as I indicated even last time, this is a discussion that is taking place between the National Treasury and Safaricom. I think those discussions are still taking place, and as soon as there's information on that particular issue, especially with regards to the tax element, then we'll be able to update you on that. I think on the action that was taken by Parliament, I don't think that affects our ability to perform our proper credit sector oversight.
So just checking that there were no last-minute questions. So given that there are none, a few others that may have come through on Slido, I think were handled during the presentation. Issues to do with so how the currency strengthened against the dollar. That question had been asked in the process, but there's quite a number of questions which have been handled through the presentation, and I think that has all been taken care of. So for now, we thank you for being with us, not just today, but throughout this year in the 6 MPC meetings and the press conferences subsequent to the MPC meetings. This, we expect, is the last one of 2024. And given that that's the case, we wish to wish you Merry Christmas, Happy New Year, and let's see each other back here in February. But for now, thank you so very much, and do have yourselves a wonderful day.